Hello and welcome to Wall Street Training's LBO Leveraged Buyout Overview course. Please note that these materials are copyrighted and may not be disseminated or reproduced for any reason without express written consent from Wall Street Training. Okay, let's talk about purchase accounting versus recap accounting. Now, on the left-hand side, acquisition purchase. What we're saying is, what if we did an outright acquisition? In an outright acquisition of a company, a new legal entity is created, which means that the target firm is blown out, there is no longer in existence. You will raise new debt, you'll be buying back all the shares, and the new equity is simply the private equity firm's equity injection to combine. What this means, again, as I mentioned, the target's balance sheet is blown out, and yes, you have goodwill that is created. Now, for a little bit more information on this upper left-hand box, please feel free to go to our Mergers and Acquisitions Deal Structuring module, in which we describe this treatment of goodwill, stock versus asset deals, stock versus cash consideration, and whatnot for more information here. This is just going to be a teaser on this, which we'll go into a lot more greater detail when we actually build our complex leverage buyout model. So again, let me reiterate this. The acquisition, or in a real purchase, you're buying out the entire company, and the old company no longer exists, and goodwill is created. Those three key points. Let's take a look at the upper right-hand corner, recapitalization. A recapitalization simply says, let me recapitalize, or let me redo my capital structure. It's a modification to the current capital structure. You have incremental changes. No new legal entity is created. The target firm is still in existence. And what you're saying is you are not buying back all, but rather you're buying back some of your shares. This is a massive share repurchase is what we're saying. How do you fund that massive share repurchase? You raise new debt. What you will have is, instead of blowing out your target company's balance sheet, you will simply have marginal changes. Again, this is sort of like a day-to-day share repurchase, if you will, except it's a large day-to-day share repurchase. And because you're not buying the company, this is not an outright acquisition, no goodwill is created, you're not purchasing the entire company. So again, hopefully now, on the left-hand side, you have a true acquisition, you have outright acquisition, the existing target firm is blown out, and the entire balance sheet is gone, and goodwill is created. In a recapitalization, you're not actually buying the company, you're simply modifying the current capital structure. You will raise debt, buy back shares, no entity is created, and you're just going to have changes to the balance sheet as if it was a regular day-to-day share repurchase, although a very large one. Now, as we have mentioned also in numerous scenarios and numerous examples in our M&A deal structuring and merger modeling courses, which would follow after this particular overview of leveraged buyouts, we talk a lot, again, about is there a scenario where we can have the best of both worlds? That was mentioned in our 330H10 election in our merger modeling course. In our recap accounting, what we're saying is, and this basically doesn't happen very often anymore. Doesn't happen very often anymore. But the reason we go over here is for two reasons. Number one, there's still a possibility. And here I would say you must consult your professional attorneys and tax accountants. You must consult your tax people. The second reason why we want to look at recap, the first again was it still might happen. You will consult your tax professionals and accounting professionals. And the second reason why is because in the building of our model, our complex model, we will need this for our status quo toggle, which we will explain further as we get into our model. In a recap accounting, what we're saying is this is a full leveraged buyout acquisition. In other words, everything on this box now being circled in black, that will apply here. However, what we're saying is, well, you can actually elect to get recap treatment. How do you elect to get recapitalization accounting treatment? First of all, what are the reasons why this is good? No goodwill is created. This is not, by the way, this is not pooling of interest, FASB 141, which got rid of that. This is not. Okay, completely separate. No goodwill is created, and you get to have a cleaner balance sheet because there's no goodwill, but you will end up with massive negative equity book value. And I'll go through that in the next slide. We'll go through a short example. How do you get recap treatment? Very simply stated, you must have rollover equity in which 5.1% of the existing shareholders roll over the equity. Specifically, the actual rule is the rollover equity must not be the acquired, but rather the acquirer cannot buy more than 94.9% of the shares. Again, if you meet this 5.1% threshold, what we're saying is we'll give you this recap treatment as if you just recapitalized, bought out the other 94.9% shareholders, and bought in a new equity stake That was the magic 5% number, or greater than 5%, 5.1. What are the advantages, again, of doing a recap accounting treatment? Number one, you do not create goodwill. And number two, for purposes of our model building, this will allow us to easily sensitize our financial model, our LBO model, to actually have a status quo toggle to say, don't do anything, no transaction, keep it as run rate valuation. So let's take a look at how this recap and treatments would be effective.